The differences between marginal tax rate and effective tax rate are primarily related to their functions. The marginal tax rate is the rate applied to the highest dollar earned, which is also known as the tax bracket, whereas the effective tax rate is the direct percentage of taxable income that must be paid. As a result, the effective tax rate is typically substantially lower than the marginal tax rate. To calculate the marginal tax rate, it is necessary to determine which tax bracket the annual income falls into, and then calculate step by step until the tax bracket of the last dollar earned is reached. The higher the income level, the higher the marginal tax rate. In contrast, the effective tax rate is calculated by dividing the total annual tax debt by the entire taxable income, also known as gross income. Calculating the marginal tax rate is often more complex and time-consuming than calculating the effective tax rate. The effective tax rate provides a clear and definitive total of the tax requirement, as it is a direct percentage of the taxable annual income. On the other hand, the marginal tax rate does not offer similar clarity, but it helps to understand how an increase or decrease in income might affect the total tax liability. The effective tax rate is primarily used for current tax planning, whereas the marginal tax rate can be used for both present and future estimations. Despite their differences, the marginal tax rate and effective tax rate share a common similarity. Understanding both is crucial for successful tax planning. Both rates provide insight into how much income goes towards taxes and can help plan for future financial decisions. Ultimately, both rates are equally important, as the marginal tax rate helps with future planning by anticipating how changes in earnings can shift tax liability, while the effective tax rate provides essential information on current earnings.